I'm Scott Judds, Chief Science Officer of AlphaDroid Strategies. With true sector rotation, we can break through the efficient frontier to achieve both higher returns and lower risk. Today, I'll show you trends are real and that markets are not efficient. I'll show you that risk and return are not mutually exclusive. I'll show you there is an optimum trend extraction method. I'll show you that trend periods and algorithms do matter. I'll show you how to build high-performance strategies. I'll show you how stationarity provides future confidence. And I'll show you why forward walk progressive tuning matters. Let's get started. I said I'll show you that trends are real, which means markets are not efficient. Let's review the efficient market hypothesis. Paraphrasing, it says, prices already reflect all past publicly available information. One cannot consistently achieve returns in excess of average, and stock and other asset prices follow a random walk model. If true, diversification is best. But if trends are real, then the efficient market hypothesis is false. Notably, we are all here because we want to achieve returns in excess of average. So let's examine some proof that trends are real. In 1994, I ran into a fundamentally important book, Chaos and Order in the Capital Markets by Edgar Peters. He discusses the rescaled range analysis developed by Edwin Hurst in 1907 for the Nile River Dam project for water flow analysis. Hurst thought he should know the character of the Nile River flow before designing the dam. Fortunately, he was in Egypt, where there was 2,000 years of data. Hurst showed in this plot of the rescaled range analysis that river flow statistics were much different from that of a random walk represented by this blue line, and that this difference was representative of its trend characteristics. Apparently, the way storms flow over the tributary collection basin makes river flow statistics non-random. Edgar Peters decided to apply this analysis to the capital markets. For the math geeks among you, the rescaled range is calculated as the average over the entire timescale, left to right, of the maximum range R in the interval n, divided by the standard deviation of the data over each time interval n. When plotted for the S&P 500 on a log-log scale, it looks like the black line. If that data was totally random walk, it would look like the blue line. If the data was a linear trend, it would be like the green line. What we see is that for longer time intervals, it is much more like a random walk. But for shorter time intervals, it clearly shows it contains trending characteristics in much the same way as the Nile River data. The slope of the line is called the Hurst exponent. Okay, that was a lot of geek speak, but here's what to remember. The same trending properties are seen for individual stocks, Japanese stocks, US Treasuries, and even economic indicators. Here, the S&P 500 is shown decade by decade, one plot overlying the next. The stability and character over time is called statistical stationarity. Its character remains stable in spite of depression, world war, politics, and technology. Market data reactions are really only about human reactions to new information. How long to believe, how long to buy in, to be afraid, or to take action. As a population, this character is baked in our genes, thus stationarity should be expected. Other evidence that trends exist can be found in this nice article in The Economist from 2011 entitled Momentum in Financial Markets, Why Newton Was Wrong. The article contains these two charts. The left one is a Credit Suisse study regarding British shares chosen for performance in the past 12 months and showing that the top 20% well outperformed the other groups. The right one is an AQR capital management study for US shares conducted in a similar manner, showing a similar outperformance of the top 20% ranked stocks. Further evidence that trends exist can be found in this industry white paper from Columbine Capital. It cites prior work by a number of researchers and, of course, how Columbine further improves the algorithms with their own secret sauce. Columbine publishes performance charts for a handful of models and sells data to capital management companies. This is their combination model, starting in 1986. I've annotated the chart to show two lines of constant return to put them into perspective. The green line is the top 10% of the sorted stocks, and the red line is the bottom 10% of sorted stocks. Finally, this peer-reviewed academic paper by Jagadish and Tietman from 2001 likewise demonstrates that trends exist in market data. In their paper, they divided the stock market into 10 portfolios, grouped according to their prior 6 months' return, and then held those stocks for 6 months and repeated the process. They found that the portfolio P1, the upper 10% of the momentum sort, produced an average return of 1.65% per month, while the portfolio P10, the lower 10% of the sort, had only about 0.4% return per month. That's a significant 16.8% per year difference. So, trends are real, and this is what they look like. Here, fund prices are plotted on the top, and their corresponding price trends are plotted below. They are plotted against time, and thus they are time domain data. Remember that term, time domain data. When the price of the orange fund is rising the fastest, the value of the trend is the highest. Thus, the best trend is our friend, and therefore, time domain data is also our friend. Yes, trends are real. Trends are by definition a portal to the future, where something in the recent past tells us something about the near future. Thus, trends are in fact the crystal ball we all hope to find. In fact, we're not limited to average performance. I said I'll show you that risk and return are not mutually exclusive, but let's review. Modern portfolio theory says one must trade risk for return. Let's check it out. Modern portfolio theory says if you have a risk-free money market fund here in green and other available investments over here in blue, then the best you can do is to construct portfolios along this efficient frontier line in red. In fact, modern portfolio theory says you can't make long-term portfolios in the upper left of this diagram. According to MPT tenets, market prices are Gaussian distributed, rational investors trade risk for return, risk is measured as standard deviation of return, risk is reduced by owning uncorrelated assets, and the efficient frontier is the set of best portfolios. But AlphaDroid thinks otherwise. On this risk-return chart of an operating strategy, it is the additional use of trend-following algorithms that enable AlphaDroid to live comfortably in the forbidden corner. Let's revisit those MPT tenets. That market prices are Gaussian distributed fails to consider the tails are way too fat in the real world. This is why 30-to-1 leveraging by banks was not safe. That rational investors trade risk for return fails to consider that new tools change the game. Indiana Jones reduced his risk by bringing a gun. That risk is measured as standard deviation of return fails to consider that big returns aren't a bad thing, and this misrepresents risk in the decision process. That risk is reduced by owning uncorrelated assets fails to consider temporal avoidance as a method of risk reduction. And that the efficient frontier is the set of best portfolios fails to consider that the efficient frontier might be an artifact of unfortunate, self-imposed constraints caused by discarding time domain trend information. Our poor MPT guy on the left says, "Can you help a disabled investor? I lost my time domain leg and I don't know what to do next." Statistics is the only leg he has to stand on. MPT mathematics are completely statistically based. Gaussian distributed, standard deviation, uncorrelated assets. Without time domain information, you have no trend information. Without trend information, MPT is limited to buy and hold. And that's why MPT can't pick anything to own or avoid next month. Let's solve the problem. We want to know how to use the blue investment options to create a red portfolio, to simultaneously reduce risk and improve returns. Modern portfolio theory says we can't get there with diversify and rebalance, but let's give it a try and see. I'm going to use the desktop version for this demonstration. The vertical axis is logarithmic such that a fixed percentage return per year makes a straight line as shown by the gray 10% return line. I've created 5 simple synthetic funds, each with a slightly different average return, and each with a slightly different sinusoidal undulation to simulate uncorrelated assets. Their average returns vary from 5% to 9%, and the sinusoidal undulation period varies from 135 days to 229 days. The upward slope of each undulation is 30% per year, plus the base level average return, so 39% per year for the orange fund. The risk-reward chart stacks the dots for these funds appropriately like this. Risk here is measured as the coefficient of variation. If we take these uncorrelated assets and diversify and rebalance as shown by the control in the lower left, using an equal 20% allocation for each, and rebalancing quarterly, where these are the rebalance indicators and rebalance dates, Then it produces the results shown by the yellow line above. With this concoction of uncorrelated signals, there are periods of time when they work together and other periods where they work against one another. On the risk-reward chart, the results show that we have achieved the average of the returns, and as expected for uncorrelated assets, the risk is reduced by the square root of the number of participating funds. In conclusion, diversify and rebalance improves risk, but not returns. Diversification didn't cut it. Let's try trends and own only the trend leader. Let's first look at trend following mechanics with a very simple example. In the upper black chart, we have a simple sinusoidal fund in green and a pretty flat money market fund charted in purple, and the strategy results in yellow. In the lower chart, we see the short-term trend indicator for the green and purple funds, indicating whether the fund is making money or losing money. A trend following algorithm says we should own the fund that has the most positive trend and thus most likely to do well next month. Thus, the yellow line goes up when the green fund has a positive return and should be owned, and bails to cash and goes flat when the money market fund is doing better. On the risk-reward chart, note that we have moved up and left at the same time. Now let's do trend following with all of those sinusoidal funds that we saw before. First, we'll zoom into a 2-year interval. Here we see the synthetic sinusoidal funds above and their corresponding trend indicators below, where each yellow hash mark indicates a trade to a new fund when it becomes the trend leader, and producing this result by owning only the trend leader. If you think of these funds as market sectors, we are truly rotating from one sector to the next, hence the name true sector rotation. True sector rotation is also called serial diversification, owning many funds, but only one at a time. As this chart shows, one can simultaneously achieve higher returns and lower risk by owning only the trend leader. And yes, this is the Holy Grail. But something is missing. Real markets have noise, and market noise makes our crystal ball foggy. Thus, the game is to extract trend signals from noisy data. This is the hard part of the job. I said I'll show you that there is an optimum trend extraction method. Fortunately, I went to engineering school at Stanford, where I studied signal processing theory, have numerous issued patents, and even authored an optical sensor book. My career has been all about digging signals out of noise, and that is the problem we have before us. It's all about reducing the noise to better reveal the signal. Seeing even a little bit of the road ahead is a good thing. There are 2 primary tools a good signal processing engineer would use. First, matched filter processing to optimally shape a noise filter. Second, differential signal processing to eliminate common mode noise. Warning, there's a bit of geek speak ahead. Consider it entertaining background material that you don't have to remember. We'll start with matched filter processing and its definition. A matched filter is the optimal linear filter for maximizing the signal-to-noise ratio in the presence of additive stochastic noise. This means the best filter shape matches the signal shape. Consider this radio spectrum signal in the frequency domain. A matched filter would be shaped to match the spectrum of the signal like this, to cut out the sideband noise. Consider this time domain signal leading to an event. If we have many such examples, we might find a correlation signal before the event, like what happens before an earthquake. In the time domain, a matched filter has an impulse response that is the mirror image shape of the correlation signal. What is the event? Let's say the problem is wanting to know, should we move to the safety of cash? We want to estimate market performance for the next month. The method will use the S&P 500 index to represent overall market health. Negative returns are, of course, indicative of poor market health. So then the event is next month's return. Thus, we must find the correlation between next month's return and the returns from the series of days prior to next month. This is that correlation. The horizontal axis is the number of days preceding the event, and the vertical axis is the correlation of the data to the event, with recent past days on the right and far past days on the left. It has near zero correlation for days immediately preceding the event and grows to a peak a few months back in time. So, again, we're looking for a filter with an impulse response that looks like the mirror image of the correlation between the event and the pre-event data. This is the correlation between the event, which is next month's return, and the pre-event data. Let's look at 3 candidate filters, 2 well-known and 1 not so well-known. In green is the 50-day simple moving average filter. Its impulse response is flat for 50 days and then goes to 0. In red is the 50-day exponential moving average filter, quite popular in market data analysis, declining exponentially to its 1 over e point at 50 days. And in blue is a 50-day second-order exponential moving average filter with a humped impulse response. It clearly looks the most like the mirror image of the correlation data. Let's check it out. When you run the correlation data through these filters with different time constants, we see that it's true that the second-order exponential moving average filter in blue performs much better. StormGuard uses the 50-day second-order exponential moving average to decide when it's time to move to cash. These plots show the returns of numerous strategies versus different time constants for the filter. Their performance peak at about 50 days is not an accident. The market pullback in the summer of 2010 was StormGuard's first real-time test since its creation. The StormGuard indicator chart on the right shows that StormGuard came close to triggering a move to cash, but did not. The bottom chart shows that in the larger perspective when compared to serious market downturns, StormGuard made the appropriate decision. However, 1 year later, in 2011, the U.S. debt downgrade and a threat of collapse of Greek debt scared the market a bit more, and for just a short time, StormGuard did trigger a move to cash. Although the natural instincts of many people is to want to pull the trigger and go to cash much quicker, it's important to remember that there is an optimum balance. If you react too fast, you suffer from whipsaw losses when sharp drops often snap back. But if you react too slowly, you'll get hurt if it really is a major market collapse. Let's specifically look at how StormGuard affects strategy performance. This is a Fidelity sector fund strategy. The green line includes StormGuard and the yellow line does not. The benefit of StormGuard comes exclusively during the 2 major down market periods in this 23-year chart. The cumulative strategy improvement achieved by including StormGuard is 86%. This second example is a Fidelity country fund strategy. Again, the green line includes StormGuard and the yellow line does not. And again, the benefit of StormGuard comes exclusively during the 2 major down market periods in this 23-year chart. The cumulative strategy improvement achieved by including StormGuard here is 65%. In summary, one can use matched filter theory to first identify the signal leading to the event, identify a filter having a mirror image impulse response, which optimizes the algorithm response, and actually produces results worthy of our attention. Next, let's address differential signal processing to eliminate common mode noise. This chart has a dozen broadly diversified funds, each of them with slightly different focus. It's pretty clear that there's a lot of common mode market noise within each of them. If we take 2 mutual funds, a finance sector fund and a healthcare sector fund, and do the usual correlation calculation over time, we see this blue line telling us they have a lot in common. However, when the 60-day moving average filter is applied to the data to remove short-term common mode noise, we see something entirely different. These negative correlation spikes are periods where longer-term fund trends are opposite one another. One fund is increasing while the other is decreasing. There's no good reason to own both funds. Diversification does not justify owning bad funds. Detecting trends is what it's all about. Let's take a step back and first examine solo signal processing, which means making a decision by looking only at a single fund. In this case, Fidelity Medical Delivery FSHCX is plotted in green above, and the red line is a money market fund. Here, our investment rule is that we'll own FSHCX whenever the trend for its daily return is higher than that of the money market fund trend, and own the money market fund otherwise. There are 10 little yellow lines on the bottom chart, each indicating a trade from one to the other. The results of these trades are shown on the top chart by the yellow line. Clearly, performance is poor, primarily because it is too often the victim of whipsaw losses. We need a second sector fund to do differential signal processing. Let's use Fidelity Electronics, FSELX, shown in red. But first, let's look at the same solo signal processing treatment. It too suffers whipsaw losses and has at least 10 trades, including this burst of indecision trades. However, when FSELX and FSHCX are played against one another to eliminate their common mode noise from the decision process, the results are completely different. Now there are only 3 trades. Now whipsaw losses have disappeared and the trade decision results are spectacular. An electronics engineer would diagram it this way. First you apply a matched filter designed to optimally extract the trend signal, and then you apply a difference comparator to eliminate common mode noise. The result is a decision of what to own right now. High-performance Ethernet and USB signal processing is done this way for good reason. In summary, it's not a solo contest. It's a horse race. Change horses to stay on the fastest horse. It's fine to change horses in the middle of the stream, but don't get whipsawed. I said that I'll show you trend periods and algorithms do matter. But which trend is my friend? There are lots of time periods, and there are lots of algorithms. Let's revisit the Jagadesh and Tietman academic paper and ask, which trend is my friend? Their choices were, for trend algorithm, the simple moving average. For averaging period, 6 months. For repeat interval, 6 months. That sounds pretty constrained to me. As an engineer, I want knobs. I want to turn all of the knobs, and I want knobs that go to 11. What happens when we turn the knobs? I picked a Fidelity sector fund strategy and plotted what happens when turning 2 of the knobs. On the bottom is the simple moving average time constant. On the right is the trade interval. And this circle in the center is where Jagadesh and Tietman focused in their academic paper. One might conclude that this red line hump for 1-month trade intervals and a shorter SMA time constant would be a better choice. On this chart, we'll keep that red line from the prior chart and we'll turn a different knob. We'll keep the 1-month trade interval, but on the right we can try different kinds of moving averages. With the SMA simple moving average in red, the EMA exponential moving average in black, the second order EMA in blue, and the third order EMA in purple. It kind of looks like they all have a pretty good zone of performance, but not so fast. Let's expand our scope and see if stocks, ETFs, sector funds, and country funds all behave the same. The charts for these 4 strategies all use the SMA simple moving average. Particularly when looking at what happens to the red line in these 2 places, it wouldn't seem to give much hope that the SMA can be relied upon. But now let's again keep the red lines from the prior chart and keep the 1-month trade interval, but this time we'll try different kinds of moving averages. In every case, the second order and third order EMA produce a nice peak. Yes, trend algorithms and time periods do matter. I said I'll show you how to build high-performance strategies. This involves true sector rotation and asset class rotation, and it involves making sure you don't put coal in your rocket engine. One occasionally sees charts such as this that tie market cycles to economic cycles. Along the top are market sectors that are said to benefit at various stages of an economic cycle. The stages of an economic cycle are identified along the bottom. This, of course, speaks to the concept of sector rotation. If we draw a wave cycle for each of the market sectors, a sector rotation model might look something like this. If one then makes an analogy to an engine, where each sector wave is analogous to a piston in an engine, then the smoothest and most powerful ride from the engine will be when all pistons are sequentially firing and there are no missing power strokes. Let's take a moment and review true sector rotation. Only by owning the trend leader and avoiding the trend laggards can one simultaneously improve returns and reduce the probability of loss. That's exactly why this strategy with only 5 Fidelity sector funds performs so well. The sector pistons it contains are medical delivery, energy services, electronics, multimedia, and consumer finance. True sector rotation is the practice of serial diversification, owning only the one best sector fund at a time. This Federal Thrift Savings Plan strategy also does quite well and inherently practices true asset class rotation because of the nature of its funds. For its pistons, it has the U.S. Common Stock Index, International Stock Index, Small Cap Stocks, Fixed Income Index, Government Securities, and a handful of Balanced Life Path funds. True asset class rotation is the practice of serial diversification, owning only the one best asset class at a time. Don't put coal in your rocket engine. It's a simple point. A rocket engine runs poorly on coal, whale oil, or even gasoline. The right fuel makes each of them run better. So what's our rocket engine? As you may recall from an earlier slide, it's a differential, noise-filtered, trend-following engine. What best fuels this engine? Sector rotation funds are the highest octane fuel. Select a set of them so that at least one candidate fund is always having a power stroke. Funds with common mode market noise transfer leadership more reliably. In funds such as these, the common mode market noise is subtracted out by differential signal processing, better revealing the trend signal and increasing the reliability of passing leadership from one fund to the next. However, commodity funds such as this gold miner fund are not only more volatile, but contain very little common mode noise, and thus differential signal processing still leaves them with high levels of noise that mask the trend signal and thus reduce the reliability of passing leadership from one fund to the next. Conversely, most bond funds and money market funds have virtually no market noise of their own, and thus they contribute no help to noise reduction during differential signal processing and leave higher levels of noise that mask the trend signal and thus reduce the reliability of passing leadership from one fund to the next. Commodities, REITs, bonds, and money market funds are often like putting coal in your rocket fuel. The degree of the problem depends a lot on what other funds are in the strategy. Please read more about common mode noise on the website. Put a sticky note on your bathroom mirror to remind you that it's a differential noise-filtered, trend-following engine. Put in the right fuel, and watch it go to work for you. I said I'll show you how stationarity provides future confidence. In other words, does backtesting today matter tomorrow? One way to test this is with split sample stationarity. In this strategy, clearly the first half and the second half of the 23-year time interval have dramatically different price performance of the constituent funds. However, if the character of the trend data actually does have stationarity, then we should find that the optimum parameters for each half are the same. Plotted here is the annualized return versus the second-order exponential moving average days for the full 25-year period in green, the first half of the period in red, and the second half of the period in blue. While it is understood that the returns during the first and second half would be different, the important takeaway from this chart is that the location of the peak in each period is roughly at 17 days. Independent of market performance, trend character remained the same. Hence, we have split sample stationarity, because optimum parameter tuning was consistent over time. Here's the takeaway about stationarity. Backtesting is about identifying the trend character of the data. Trend character is agnostic to market direction and pattern. If you tune your strategy well today, tomorrow it will still be tuned. I said I'll show you why forward walk progressive tuning matters. The question is, can these trades really be found walking forward in time without the vision of hindsight? Let's find out. Forward walk testing is a more rigorous test and is the gold standard for backtesting. Progressive tuning allows the algorithm to adapt to changes in the data character over time. As illustrated here, at some point in time labeled now, the algorithm looks back over all past data and determines how best to tune the strategy. Then it uses these parameters for the next 125 days and pauses again to repeat the procedure, and so on across the span of time. Forward walk progressive tuning produced the nice results shown on this chart. Here is a comparison of the strategy using forward walk progressive tuning on the right and the same strategy tuned by hand in hindsight on the left, showing remarkably similar performance and illustrating that strategies with stable characteristics can be built. However, sometimes the performance of a strategy degrades under forward walk testing, as did this one. Why is that? It likely means that you have some coal in your rocket engine, and that means leadership is not transferred reliably. Forward walk testing is a tool for discovering this problem. It turns out that this strategy includes the Fidelity Gold Fund, previously identified as a commodity fund that upsets reliable transfer of leadership. Your job is to eliminate the culprit and fix the problem. The strategy can now reliably walk forward in time with excellent performance. Finally, one might reasonably ask, if fund data has stationarity, what value is progressive tuning? The set of funds in a strategy is like a team, and when you change the team, it may change the optimum way the team plays together. For example, on a football team, if you change the quarterback, you may find that a running game now works better than a passing game. In this strategy, the original team was a set of stodgy asset class funds. Starting in 2006, the team acquired 5 much more aggressive sector funds. The blue line in this chart shows the strategy tuning profile in 2006, and the red line shows the strategy tuning profile today. The arrows mark the peak performance of each. The addition of the sector funds changed the optimum tuning characteristics of this strategy from 45 days to 22 days. Progressive tuning is really about adapting to the evolving set of funds in your strategy. Indeed, forward walk progressive tuning matters. Let's review. I showed you that trends are real, that you don't have to trade risk for return, that there is an optimum trend extraction method, that trend algorithms do matter, how to build great strategies, and that forward walk progressive tuning matters. Better yet, it's automated and it's easy.
With true sector rotation, you can break through the efficient frontier. Now, let's go make some money.